All right, let's dive right in. Today, we're talking about something that can literally turn small, consistent savings into some serious wealth over time. We're talking about the power of compound growth. Now, that's a pretty big claim, right? But honestly, it perfectly captures what we're about to unpack. And look, this isn't some get-rich-quick scheme. No way. This is all about a patient, powerful process that just works quietly in the background, building on itself year after year. Okay, so what is this powerful force, really? Let's break it down. We're going to look at the mechanics of compounding and see exactly how your money starts working for you. At its heart, it's actually pretty simple. First, your initial investment, the money you put in, earns a return. But here's the kicker. That return gets added back to the pile. So the next time you earn a return, it's on a bigger amount. It's like your money is starting to make its own money. And this slide just lays it out perfectly. With simple interest, your growth is just a flat, straight line. Predictable, but kind of boring. But with compound interest, well, that's where the magic happens. Your returns start earning their own returns. And that's what creates that amazing curve you hear about, the one that gets steeper and steeper over time. This really shows you the cycle in action. It's simple. You invest, you earn returns, you reinvest those returns, and then, boom, you're earning returns on a bigger pot of money. This isn't a one-and-done thing. It's a loop that just keeps feeding itself. That reinvesting step, that's the whole secret sauce. It's what keeps the engine running and turns a tiny snowball into a massive avalanche. So if compounding is the engine, then time, well, time is the fuel. And honestly, for most of us, it's the single most important ingredient you have. Let's really see this snowball effect in action. Okay, let's imagine you start with just $1,000. That's it. And let's say, just for this example, we're getting a 10% annual return. Let's see what happens. So after 5 years, you're looking at just over $1,600. I mean, it's a nice little gain, for sure. But this is just the beginning. This is the slow part of the curve. But now, look at this. Fast forward 30 years. That same $1,000 investment has exploded to over $17,000. The growth just becomes, well, it's almost vertical. The gains you make in the last few years completely blow the first couple of decades out of the water. That is the raw power of time. This famous quote really just nails it. The big takeaway here isn't about being a genius who can time the market perfectly. It's about time in the market. That's it. Understanding this one simple principle is the key to putting this incredible force to work for you. All right, so we get what compounding is, and we've seen just how crazy powerful time can be. Now for the practical part. How do we actually, harness it? Well, it really just comes down to a few simple but absolutely crucial habits. So here's the deal. You have to keep that loop spinning. It's that simple. When your investments pay you, whether it's through dividends or just growth, that money has to go right back in to become part of the main pot. And consistency, just as important. Drip feeding even small amounts of money regularly is often way more powerful than trying to be a hero and time the market with one big investment. Now let's be real. Markets do not move in a perfect straight line. As you can see from a chart like this, there are going to be ups and downs, sometimes really sharp ones. And it can be so tempting to panic and sell when things look bad. But long-term investors, they know that over decades, the trend has historically pointed up. Those dips, they're really just noise on the journey. And that brings us to maybe the most important mindset for any investor. Just stay the course. Seriously, don't let the short-term drama of the market scare you away from your long-term goals. Patience is what lets that compounding engine do its thing without getting interrupted. Of course, knowing what to do is only half the battle, right? It's just as important to know what not to do. So let's look at a few common mistakes that can completely break the compounding chain and basically reset all your hard-earned progress. First up, high fees. Think of them like a constant drag on your compounding engine, just slowly eating away at your growth. Second, emotional trading. Selling in a panic or buying into the hype. That's the fastest way to buy high and sell low. And finally, and this is a big one, pulling your money out too early. Every single time you interrupt that process, you're forcing that snowball of yours to start over from a much smaller size. And this really brings it all together, doesn't it? For most of us, building real financial security isn't about a lucky lottery ticket or some hot stock pick. Nope. It's built by saving and investing consistently over a really long time. That is how you let compounding do all the heavy lifting for you.
Just remember, this whole journey to financial well-being, it's a marathon, not a sprint. And now that you really understand compounding, you've taken the first and, honestly, the most powerful step. The simple secret is right there on your screen. Learn the principles, invest what you can, and just repeat the process. Believe me, the future you will thank you for it.